London gold bulls are puzzled why gold hasn't performed in the face of geopolitical uncertainty and a surging oil price. Veteran traders and analysts such as Jeff Rhodes of Rhodes Precious Metals Consultancy contend that the main reason is the stronger U.S. dollar. Gold is an effective currency, and historically when the dollar has been strong, it has weakened and vice versa. When gold failed to break through $1,365 an ounce April peak, holders became impatient and began selling, Mr. Rhodes recalls. When the price slipped through the 200-day moving average of $1,307, selling accelerated, driving gold down to $1,282 before the slight revival to $1,296 an ounce. The other reason for gold's disappointing performance has been rising U.S. Treasury bond yields, with the 2-year U.S. Treasury bonds at 2.53%, 5-year at 2.85% and 10-year yield of 3%. These yields have underpinned the dollar, which has also risen against the euro because of Italian and Middle Eastern uncertainty. Generally, when prices are weaker, physical demand from jewelers and hoarders in China, India and other emerging markets increases. According to the World Gold Council (WGC), which is backed by mining companies, China at 967 tons and India at 666 tons last year, accounted for 53% of global consumer demand last year. This consumption tends to stop any deeper gold price slide. Moreover, super-rich investors continue to buy as they wish to hide their wealth under the cover of gold. Central banks from Russia and China to Turkey have also been diversifying their reserves by buying gold. These nations do not want to be dependent on the dollar as they fear U.S. reprisals, sanctions or trade protectionism. Historically, however, American, European and Japanese investment and speculative buying have spurred gold to new heights. So far, low global short-term interest rates, worries about inflated tech and other equity prices, oil's ultimate impact on inflation and Middle Eastern conflicts, have failed to reignite notable investment interest. As reported in the Business Times, the global stock of gold estimated at 190,000 tons by Metals Focus is a greater influence on the gold price than annual mine production. The swing factors are investment and speculative demand. Future mining output and development of reserves will be dependent on higher prices. These counterbalancing issues have kept gold within a wide $1,250 to $1,365 trading band. The WGC has issued a 30-year analysis report on what the gold market would be in 2048. Obviously, economic growth and wealth creation in massive population nations such as India and China are likely to boost demand in the long run. John Reed, head of research at the WGC, contends that, in the near term, Indian gold demand may increase substantially if the government succeeds in raising rural incomes. This demand could largely be met from the 25,000-ton stock of gold which is already in India. In China, traditional 24-karat gold jewelry will become much less common and 18, 22 and modern 24-karat jewelry will predominate. Other emerging markets such as Vietnam, Indonesia and Cambodia are likely to drive gold demand in Southeast Asia, while demand in Africa may increase, he maintains. Meanwhile, gold's potential role in money laundering, smuggling or tax evasion is being addressed by governments, Mr. Red contends. Sliding equity and bond markets and a weaker dollar may also bolster gold. Greater amounts of bullion will also be used in electronic and technical devices in coming years, Mr. Red predicts.